Let us now wrap up this learning module. We have some discussion left to do regarding hedge funds and private equity. So, first of all, what did we say was traditional investments, long only, right? And public stocks, so public equity. But if you went long, but you went private equity, like investing in companies which are not public listed, that's private equity, and we're going to talk about that shortly. But if you're investing in public equity, right, your stocks, but you're not just going long only, you're going short as well. You're hedging your position. So that's where the word hedge fund was invented, because what you're doing is you're going long, but you're also going short and you're hedging your position. Now, that's not the only hedge fund strategy we have now. Of course, there are so many others, but you can say that's the original strategy, the long short. And because they do that, they are able to cancel out the risk. Right? They're not taking risk, because on one side where they do take market risk, on the other hand, they cancel out that market risk, and maybe they develop something called beta neutral. So no risk at all, which means unlike your passive investments, which would say, okay, whatever will be the performance of the market, that's what we're going to try and match. Here, we can get into an absolute return target, not something linked to the market, but just in absolute terms that, okay, we're going to try and make 50% for you this year, regardless what the market does, right? Because, I mean, even if it goes up, we make money. Even if it goes down, we make money. The way they try to do that is because they go long only those ones which they feel are undervalued, right? And the ones which they feel are overvalued, they will go short. So if the market does go up, the ones that are undervalued should go up more than the ones that are overvalued will go up more. And if the market crashes, these guys which are overvalued will crash a lot harder than the ones which are already undervalued. So that's how they make money. And because they are not really linked to the market as such, then what we could say is they have a low correlation with the market. And because they're managing their risk, so they can afford to take a higher leverage, right? Which means they can use borrowed funds to even take positions. And why they can do that is because their risk is low or zero. So they don't have a problem using borrowed funds to take risk. And of course, they're going to charge you a fees for all this, right? This is not a passive buy and hold strategy where you're just having the fund manager managing an ETF for you and just replicating S&P 500. These guys are actually identifying overvalued stocks, identifying undervalued stocks, right? Overvalued, undervalued, and then creating this entire strategy for you and executing it. So naturally, not just do they take a management fees, they also take a incentive fees or performance fees, which is linked to their performance. So if they generate 50% for you, they might take up 20% out of that. And same thing for private equity as well. Of course, the strategy is very different. They're not going long and short public stocks. They're going into private equity, and even at a very early stage. So think about it in terms of startups, right? Or think about it in terms of mature companies. And Hilton and Blackstone is a good example. That Hilton obviously is a mature company, and Blackstone bought it, took it private, and then sold it back. So the whole point is to sell the company back with a substantial gain. And why do they take it private? I mean, obviously a startup is already private to start with, but why would they take a mature company which is public and then take it private, fix it up, and then sell it back again? Because you're able to do a lot of things to private companies which you cannot do to public companies, because there's a lot more regulation, a lot stricter regulation for public limited companies. Right. So in terms of the fees, there's a management fees here as well, just like your hedge fund and like your mutual funds, right? But what differentiates your mutual funds with your hedge fund and private equity is this significant performance fees, or called carried interest in the case of your private equity funds, which is basically the same thing as a performance fees, that you get a share of the profit. There might be transaction fees as well. There might be some interest income, investment income as well. But primarily, These two are the main ones. And that is it for this very, very interesting learning module. We looked at the diversification ratio. We want it to be lower, which means the numerator has to be smaller, which is the risk of the portfolio divided by the risk of any individual security, right? So together, the securities actually reduce the risk of the portfolio. And of course, that really depends on the correlation between them. But yeah, the general idea here is diversification reduces portfolio risk. Now, RRTTLLU, very, very important, right? Risk and return, time horizon, tax, legal, and unique circumstances. RRTTLL, legal and liquidity and unique circumstances. RRTTLLU, very, very important, all the way to level 3. So once you understand the client needs, you make their IPS, investment policy statement, right? And then based on that, you do their strategic asset allocation. Temporary deviations are called tactical asset allocations, right? But yeah, that's done across asset classes. Then within the asset class, let's say you're putting 40% in equity, okay, what stocks? And then start buying those stocks. And then of course you have to monitor and rebalance, things go up and down. And you have to measure either an absolute benchmark or a relative target that, okay, either you're saying I'm going to make 50% regardless of what the market does, or I'll make 10% over and above what the market will make. So it can be a relative or a absolute target that you might have, and obviously you need to keep reporting to the client. Now, different clients means different requirements. In terms of time horizon, the shortest one is with banks and the longest one is with your endowment funds, right? And the reason for that is because banks have the highest liquidity needs and endowment funds have the lowest liquidity needs. And then in the middle, you've got insurance companies, property and casualty, short, not the shortest like banks, but still relatively short. And then you've got pension funds and life insurance companies, which are long, not the longest like in like endowments, but longer than your property and casualty and longer than your pension funds. Now, longer than your property and casualty. So pension funds are long and insurance companies, life insurance are long. Now these guys, your mutual funds and your individuals really depends on who they are and what they're doing. So various different strategies can be there and individuals can have various different goals. They can have different stages of life, right? So it really depends on who they are, where they are in their life, what are their expenses, what is their income, and then how much risk appetite they can take. What's their risk appetite? In terms of the pension fund, we talked about the two different types, the contribution which is defined or the benefit that is defined. So in terms of the contribution being defined, the company just puts in a certain amount of money and then it's up to the employees to manage that fund and they are the ones who take the risk. Whereas defined benefit is where the employees are relaxed, the company takes a certain responsibility and then it's the company's headache to make sure the plan is invested properly. We talked about the general aspects of your asset management industry. It is huge, trillions of dollars, right? There's a buy side, there's a sell side. And of course, we can work for both sides, right? At any given point in time, you can be either working for the buy or the sell. And within that, there's people who are trying to outperform the market, which is active. People who are just trying to keep up with the market, that's passive. Your traditional investment managers are long only, right? Your alternatives are doing long short, going into private capital, which could be startups as well. So that's venture capital, right? They structure themselves as LP, GP, right? And this is something that is discussed in your alternative investments, but it's very simple. The GP is the fund manager, right? And the LP are the investors. And the beautiful thing about that is that their liability is limited. The LPs, the max they can lose is their investment, but GP is having unlimited liability. We talked about big data, robo-advisors, and how that is really helping us with the mass affluent segment to be able to serve the mass affluent segment, which is like people who have between 100K and $1 million. Now, people who have less than 100K, well, mutual funds are a pretty good option for them. pooled investment products, right? We talked about what is the NAV of a fund, how an open-ended fund trades close to the NAV, but you can only deal with the fund manager at the end of the day to have new investment coming in or going out. Closed-ended usually trades different from NAV, and majority of the times it is trading at a discount to NAV. You can't have new investment coming in, but the good thing is you can trade during the day. You can have a front end load, a back end load, or no load at all. And we also talked about what are the different strategies these mutual funds follow. So they could be just investing in the money market, which is less than 1 year maturity fixed income. Bond is more than 1 year maturity. That could be government and corporate both, right? You can have stock or equity funds, and then you can have index funds, which is also stock, but no particular bias towards any index or any sector. It's just like the entire market that you're tracking, right? So more of a passive situation over there. And then you can even have your balanced fund, which is like half bond, half stock. But of course, nothing like an ETF, because it combines the benefits of both closed and open, which means it can be traded during the day and investments can be scaled up or scaled down. And thanks to the financial institution that helps us, for their own benefit, because obviously they like that arbitrage risk-free profit, but they keep the value close to NAV, right? If the unit is going very high in the market, they will start selling it to bring it down to close to what it's worth, and if it starts going low, they'll start buying it up. And of course, you can buy more units and they'll just issue for you if you're driving the price up. And if you want to sell your units, they'll buy from you if you just sell it to them at a little bit lower than what it's worth. So this is really good. And it's tax efficient, and it's also operationally efficient. The expenses are low, the taxes are low. So I mean, ETFs are just lovely. Right now, if somebody is having more money than just a few $100s, so they don't have to go to a mutual fund. They can actually, if they have like 100K plus, they can go for a separately managed account. So that's pretty good, because you get a customized service and you can optimize for your taxes, right? This is also called a managed account, a wrap account, or an individually managed account, and very, very popular as well. And of course, if you are talking about $1 million plus, then you can get these guys, these hedge fund and these private equity guys to manage your money. And we just talked about that in detail, right? So very interesting learning module. Hope you enjoyed it and hope to see you in the next one.